The U.S. Baker Hughes Oil Rig Count is a widely followed indicator that tracks the number of active oil rigs operating in the United States. This data is compiled and published weekly by Baker Hughes, a global energy technology company. The Baker Hughes Oil Rig Count serves as a crucial gauge of the oil industry's health and is closely monitored by economists, policymakers, investors, and energy professionals to assess current oil production levels and the potential future direction of oil supply. The Baker Hughes Oil Rig Count refers to the total number of drilling rigs actively exploring for or extracting oil in the United States. This count is broken down into two categories: oil rigs, which are rigs specifically drilling for oil, and gas rigs, which are rigs drilling for natural gas. The data is typically released on a weekly basis, and it reflects activity in key oil-producing regions such as Texas, North Dakota, and the Gulf of Mexico. The number of active oil rigs provides a direct measure of exploration and extraction activity in the oil industry. An increase in the rig count generally indicates that oil companies are expanding their exploration and production efforts, which typically leads to higher future oil output. Conversely, a decrease in the rig count can signal a slowdown in drilling activity, potentially leading to reduced oil production. The rig count is closely watched by energy traders, as changes can signal shifts in the supply side of the oil market. A rising rig count can indicate that oil companies are responding to higher prices or increasing demand, while a declining rig count may suggest lower oil prices or reduced profitability in the industry, leading to decreased drilling. Oil production is a significant contributor to the U.S. economy, particularly in energy-producing states like Texas and North Dakota. As a result, fluctuations in the rig count can provide insights into broader economic conditions. For example, a decline in drilling activity may point to lower oil prices, reduced investments in energy infrastructure, or concerns over global oil demand. An increase in the number of active oil rigs often reflects confidence in future oil prices and expectations of higher demand. If drilling activity rises due to higher oil prices, it can signal that producers are optimistic about the future, which could contribute to further upward pressure on oil prices. However, if rig counts increase significantly in response to rising oil prices, it may lead to concerns about oversupply, which can ultimately stabilize or lower prices. Conversely, a decrease in the rig count can indicate that oil companies are scaling back drilling activity due to lower oil prices, poor demand outlooks, or concerns about profitability. If fewer rigs are drilling, this can indicate reduced future oil supply, potentially putting upward pressure on oil prices. However, if the rig count drops significantly, it could also suggest that producers expect oil prices to remain low for an extended period. The primary driver of changes in the rig count is the price of oil. When oil prices are high, oil companies tend to increase drilling activity because the returns from production are more attractive. Conversely, when oil prices are low, companies may cut back on drilling to avoid unprofitable ventures. Advances in drilling technology, such as hydraulic fracturing, have made previously uneconomical oil reserves more accessible. As technology improves, oil companies can operate rigs more efficiently, allowing them to drill in new areas and at lower costs, which may increase the rig count. Fluctuations in global oil demand, due to factors such as economic conditions, energy transitions, and geopolitical tensions, can also affect the number of active rigs. For example, a significant supply disruption in key oil-producing regions can impact drilling activity in the U.S. and lead to changes in the rig count. Changes in government regulations, environmental policies, or tax incentives can influence the rig count. For example, policies that promote energy independence or provide subsidies to oil producers may encourage more drilling activity, while tighter environmental regulations could lead to a reduction in exploration and drilling operations. A rising oil rig count typically suggests that oil producers are optimistic about the future price of oil and are willing to invest more in exploration and production. It could indicate that companies are responding to higher demand expectations or favorable market conditions, contributing to an increase in supply. A declining rig count may signal that oil producers are scaling back operations due to lower oil prices, reduced demand expectations, or lower profitability. This can reduce the future supply of oil, potentially leading to higher prices if demand remains stable or increases. A stable rig count often suggests a balanced market where production is meeting current demand levels. If the number of active rigs remains unchanged over several weeks, it may indicate that the market is neither undersupplied nor oversupplied, with oil companies maintaining production at a steady pace. The U.S. Baker Hughes Oil Rig Count directly influences the nation's overall oil production levels. As rigs are added, oil production tends to increase, especially in key shale-producing regions. Conversely, as rigs are removed, it can lead to a slowdown in production, potentially affecting the U.S. oil supply. For example, the Permian Basin, which has seen significant growth in recent years due to technological advancements, is often a key contributor to increases in the U.S. rig count. The level of drilling activity in this region is closely monitored, as it directly impacts the total oil output of the United States. Investors and analysts closely track the Baker Hughes Oil Rig Count because it can offer insights into future oil supply trends. The oil rig count can impact not only oil prices, but also the stock prices of energy companies and related sectors. A rapid increase in the rig count could signal a period of increased supply, potentially putting downward pressure on oil prices, while a sharp drop in rig counts might lead to higher oil prices due to reduced supply expectations. Additionally, energy investors and commodities traders often monitor the weekly release of the Baker Hughes Oil Rig Count for any signs of changes in drilling activity, especially during periods of market volatility. Over the years, the Baker Hughes Oil Rig Count has seen significant fluctuations, largely driven by global oil prices and shifts in demand. For example, following the 2014 oil price crash, the U.S. rig count sharply declined as oil companies scaled back operations due to lower profitability. Conversely, in periods of high oil prices, rig counts have increased as companies rush to capitalize on higher returns. The rig count has also responded to geopolitical events like the OPEC production cuts and shifts in U.S. domestic energy policy. The U.S. Baker Hughes Oil Rig Count is an essential tool for understanding the health of the oil industry and the broader energy market. It serves as a leading indicator of oil production trends, offering insights into future supply levels and influencing oil prices. The data provides valuable information to policymakers, energy companies, investors, and economists, helping them gauge the impact of changes in oil rig activity on overall economic conditions.